Hi, good morning, everyone. Hope I am audible to all of you. Can you hear me, guys? Happy morning and a powerful Sunday. Come today, let us unlock the trading secrets using one of the traditional and oldest indicators, that is moving averages. Moving averages, if they are tweaked, we can use it very powerfully. So I am going to share with you and discuss with you some of the insights on the moving averages, and we are going to learn, earn and prosper today. This event is hosted by webinars, so you are going to learn, earn and prosper today. Let us discuss the trading secrets of revamped moving averages. Guys, I'm going to introduce about myself, a small brief about me. I am Raju Yangadi Vishwanath RV, a SABI registered research analyst, a chartered market technician and a certified financial technician from IFTA US with 15 plus years of experience in the research desk with the mid-sized brokering firms. I work on the research desk for a couple of brokering houses. Also, I have a multiple association, so I work as a consultant. I am a trader, trainer, and a transformer. That's a small brief about me. Let us kickstart the session. So, what is a moving average? It is a part of a trading cluster, what we call key to establish your trade setups. A part of it, obviously, when you use the moving averages in a diligent and proper designed and designated way, they will help you get the gauge of the trend, and also a lot of insights we are going to discuss with simple and unified models where it will help us to learn and prosper. Approach, everybody says moving averages are lagged. I'm going to define a moving average. What do you call it as a moving average? When you add a sum of closing prices, it's a part of technical analysis, a chart indicator that shows the average value of a security. The average would be taken on the closing prices. High low close also would be taken. Different methods are there, parameters are there. We are going to introduce a part of it, then we are going to test the different techniques and tweak it practically together today with the charts. I want you to apply the moving averages and get the results rather than understanding the formula of the moving averages and get into the insights of the formula. Formula doesn't give us the results, but understanding how it works, which of the moving averages are better and what is the time horizon you can use the moving averages, that we are going to learn. How you can use it as the trading clusters, a part of support and resistance levels, what we called as supply and demand zones, and also how the potential entry and exit points can be defined using the moving averages. Today we are going to get the a sneak and a glimpse of it together. Are you guys ready? If you are ready, write up yes in the chat box. So guys, are you guys ready? Write up yes in the chat box. Are you able to access the chat box, my dear friends? Am I clearly audible to you all? Hope I am clearly audible to all of you. Write up yes in the chat box if I am clearly audible to all of you. Are you able to write up in the chat box, my dear friends? Hello, my dear friends. Are you guys ready? Can can you receive in the chat box that I typed hello? If you are able to access the chat box, type yes. So you can use moving averages as the entry exit point. Okay, my dear friends, most of them are ready. Yes, we are discussing. I'm going to apply it on the charts going ahead. So let's understand the brief preview here. Then we'll get into the application part of the moving averages for the entry exit points, using them as the supply demand zones, support resistance points with the different time frames where we are going to get the preview and how you can prepare it to your advantages. Oh, what does a moving average indicate and why it is used? Used to identify the potential buy and sell opportunities. A buy and sell opportunity can be identified with the moving averages. See, basically, what do we do? Summation, like adding the averages, like average closing price. Every day's close, like 100 plus 100 plus 100. You add 100, let us say 100 plus 105 plus 108 plus 111 plus 123. 547 divided by 5, it's 109.4. It's a simple moving average of 5 periods or a 5 days, let us say. So this is how it is calculated. I'm showing it to you on the calculator. So that's the basic part of simple moving average. Other moving averages have different formulas. I don't want to get into the formulas today. I want to get into the application of the moving averages, my dear friends, where we are going to learn how to use it for your trading. No nonsense, pure business, like how the business can be done and what it helps us and how you can use, like use to identify the potential buy and sell opportunities. There are 5 points, like trading clusters, key support and resistance zones can be used with the moving averages. Identifying the gauge of the trend. The trend is assumed to be in motion until a reversal is signaled. As per the Dow theory, trend is assumed to be in motion until the reversal is signaled. So that is very much important while trading with the moving averages. I'm going to add up some part of the Dow theory as well. Crossovers are there, moving average crossovers, like around 20, 50, 50 and 200, the basic what most of us know, and also to measure the volatility. So these are the 5 key points where one can use the moving averages as an indicator. Let us discuss some of the advantages and disadvantages of the moving averages before we get into our depth and the practicals. Like it helps in identifying the trend. It's a trend following indicator rather than reversal, even if it acts as a support or a resistance. I'm going to share what is the support, what is the resistance. Most of you, how many of you know what is the support, what is the resistance? I believe everybody knows the support as well as the resistance, my dear friends. So great. So it helps in identifying the gauge of the trend crossovers and measures the volatility. Also, it's a trend following indicator. It eradicates the noise. The market never moves up in a straight line or comes down in a straight line. So rare instances do happen, knee-jerk reactions. For that, there are different strategies. That is not the context of the session. So to smoothen the noise, averages help us until the trend is assumed to be in motion. It simplifies the trend, eradicates the noise. See, there are disadvantages of moving averages, but how to use them to the advantage we need to understand, and we are going to understand in this session, my dear friends. So, calculated based on the past prices, moving averages are calculated based on the past prices. It lags behind the price action. Obviously, price action is ultimate. It creates the whipsaws in sideways markets. Sideways markets, when the markets move in a range, then it creates a whipsaw. So let me draw you certain points. So basically, we need to understand the trends. So let me draw the certain points for you. See, market moves up like this in trends. It's a uptrending market. This is a downtrending market. Hope you can see my screen, my dear friends. And the sideways markets are completely like this, which will move in a range. This is called a range bound market. In this, moving averages doesn't work. Moving averages work beautifully when you have a trend like this. So this is how the moving averages work, my dear friends. In a simplified context, see, this is a uptrending market where the simple averages can be drawn. In this sideways markets, the whipsaws would happen. I'm going to share with the charts. Yes, so definitely in a trending market, moving averages work. Let us see some of the examples with the charts today. So I'm going to share certain averages here. Let's see the example with the Nifty. See how the trending markets it is giving a momentum. Continuation of the trend and the continuous action. See, it's at least what you can do with the moving averages. Using these moving averages, what it will happen, this will help you ride the trend. Hope charts of Nifty is visible to all of you. Can you guys see the charts of Nifty? Hello. I am not muted, sir. I don't know. It's unmuted. Okay, am I audible, guys? Can you hear me? Okay, great, great. We can go ahead. Sorry, some disturbance was there. Great. So now we are getting the gauge of the trend here. We are seeing a range bound and sideways markets. I have marked the sideways markets, uptrending markets, and the downtrending markets we have marked. So now we are defining the entry points. Once this range is broken out, 25 for 23 is the entry point. This short term average below this is the stop loss point. So I am going to define how to gauge the trend and how to ride the trend. This is the entry one. Right, guys? This is the entry one. This is the stop loss. 25 347. The gap area would be the stop, or the candle low also can be the stop, my dear friends. The candle low can be stop. So this is the first entry point where our entry is 25 423. The next entry point is here, 25 624. Our third entry point is here. See, while trading the moving averages, I would prefer entering only three entries. I'm going to add on to the position as the trade enters, because on the fourth and fifth iteration, the entries are usually going to mature enough. So I'm not buying, I'm riding the trend after three entries. So where is my exit? This is my exit. See, first of all, we need to understand the range. Always, while trading the markets, understand the range of the markets in any time frame. We are now seeing this on the, until the average is broken, we are riding the trend. My short term selling point only will start from here, 25 875 to 920. See, 940, the break, 920, let us say 920 only is the exit. Great. 25 920 is our exit. So what we are going to do here? Now we have taken the three entries. not used only moving averages. I used the range bound market, consolidation market, which has broken out on the upside. I am using the moving averages as a cluster where the entry can be defined after a breakout. Simple strategy which can yield you results. 25 4 23 is the first entry. 25 6 24 is the second entry. 25 780 is the third entry in the Nifty, divided by 3. Okay, my entry point is 25609. On an average, we are riding it. See, stop loss here it is some 70 points stop loss we are kept, like 23 plus 53, 75 points stop loss we are riding the target, and our exit point is 25 920. So how many points we are able to capture? 311 into 3. It's a 933 points which were captured. Obviously, as the moving averages goes ahead, we have to trail the stop losses. Stop losses we are going to discuss in the future part of the sessions. Different methods to use the stop losses. There are tens of methods I'm going to define. Even the emotional quotient also is important while defining the stop losses. So that is a different context, but here writing the profits and gauge of the trend, I am simple trend following strategy I'm giving you. With the 76 points SL, 933 points were gained. What is the move from here? 25,070 to 26,070. Let us say the move of 1020 points, 3 lots out of 3 lots trading. So, was this a beautiful trend to capture, my dear friends, with a simple moving average concept? Do you guys agree? Say yes in the chat box. It's a simple concept what we are designated. Hope you guys. Definitely, I'll give it, sir. Algo trading is not the concept as of now. Today's moving averages. So basically, we have been discussing the quotient of moving averages, like how to use the moving averages in a designed and designated way. Hope I am audible to all of you, my dear friends. Definitely, we are going to discuss stocks also, sir. It's start of the session. It's start of the session. It's not the end of the session. We are going to discuss lot of aspects of it. I hope I am audible to all of you. Great. So if you can't make it understand to a 6-year-old, you don't understand it yourself. It's a simple strategy to ride the trend, but how many of you can apply? Can you guys apply with the removing the emotional quotient? Can you guys apply? It's all about your emotional quotient. How you guys apply even a simple strategy to make profits? This is on an uptrending market. Obviously in this downtrending or sideways markets, It will chop you out, but you need to define the certain rules. You need to define the certain rules of entry. See, let us see the downtrending market here. Here the multiple sideways action happened where it chopped out the traders. Obviously, our stops would be hit. Maybe trend following strategies are accurate around 40% of the time. It's a combination of indicators along with the methods what we apply that you can design as algo, not only one indicator which will give you the algo. So a combination is always required while you trade the algos, like continuation of a downtrend. See, basically what we do. So this is how the market moves, right, guys? So whenever the previous important low, swing high or swing low breaks, it's an opportunity to trade. Forget the counts, just understand the previous swing high and swing low breaks, we are buying or selling. So this is the first part of the Dow theory what we are establishing. So hope you guys understood. Whenever this high, previous designated high is broken, we are going to buy. So that is a simple rule what we all follow. At least as a technical research analyst, we apply. So what happens? That is the first condition to enter the trade. A swing highs and swing lows. A multiple retest and close below this. The trend has started here. Here again the second gauge of trend has started. So the swings have been broken. See, definitely I am going to enter on a reversal here. This is my first entry point where the price cluster has been done. The previous swings first entry would be this. If a trend confirmation has come here, my entry would be somewhere here. So here two trades can be done on the downtrend I am saying. For me, this is my first entry. Where this point. My second entry would be here as the trend continues. So where will I exit here? A small trend within a trend. At least at this point I'm going to exit. Let's calculate it. So I'm going to I'm sharing you with the different scenarios. So that's it. Nothing exceptional. Here would be our exit, at least the second average. If the price closes above the, you need to match the conditions. If the price closes above the second, at least the second average, you can exit. So friends, let us calculate here. My first entry point is 25,181 for sell. Second entry point is 25,140. So 25,160 is my entry. Where is my exit? 25,181. So here 20 points of loss has been incurred. Again, the next trade we are entering now, same entries and exits I am defining. This is my first entry point here. So I am drawing the third entry point here to get the gauge of the trend. We have got an exit point here. So what we have done here, our first entry point is 25,140. Let us say 25,200 is a stop loss, 60 point stop loss. Initially we are entering. The second entry point is once the breakdown occurs 25,030. So let us define it. 25,080, and if the gap area also can be the stop loss or above the averages, also let us define it in a simplified way. 25,080 is our first entry point. Sorry my dear friends, 25,180 is the stop loss. Our second entry point is 25,030. The third entry point is 24,940. With a 100-point stop, our average is 25,016 and we have been riding the trend. What is our exit point above the second average? This is the exit point, 24,748. So 268 points could have been captured even using the simple moving averages. Here we whipsawed by 20 points, 268 points. So it's all about understanding the trends and gauging the trends. So that's on the momentum. Like even on the sideways markets, we get whipsawed, but we need to understand the range of the markets. When the range of the markets, how to identify the trends, we are going to discuss in the different part of the session. But how the averages can be used, I am defining the entry and exits. So why I have entered at the entry point 1, I am going to share here. So I am going to share a trick of the candlestick. What happens here when this kind of a trend occurs? How it is helpful? Let me define. Can you guys see this big candle? The candle. Are you guys able to understand the strength? The big candle where the sellers have driven the prices down below the support. The candle, strong candle, a bear candle. The power of the candles, what we call it as. Can you guys see it? Am I audible, my dear friends? Can you guys see it? Okay, Mr. Indrajit ji. So what I am showing it is I zoomed it. Hope I zoomed it. It's visible to all of you. Hope I zoomed it. Chat box is enabled long ago. Yes, so let's get back to the session. So the strength of the candle here, the strong bearish bell told candle is formed. Below the averages, the markets are trading and the strong bell told candle is formed. And we are seeing the momentum gauging it down. So the consolidation happens here and the average crossover gives the continuation again here, the selling opportunity. And this big candle, not even 50% of it is retraced. Even the next 1 hour consolidation and multiple shooting stars have occurred and again the reversal starts. So from here if you start selling, here also we were not able to close above the averages and the reversal occurs and again the momentum breaks down. Here the entry point 2 is defined around 25,030. That is why I had taken it as a gauge of the trend. The momentum is clearly bearish and the entry point 3 has been taken here around 25,940 levels, 940, 950 levels. So this candle closed 25,944. So there you could have sold out the third entry. Continuation is a simple method to earn profits. Markets, one needs to have patience. Perseverance always pays back. And simple trend following strategy we are discussing. Many might be knowing. How many of you apply a simple candlestick pattern, a strong bearish bell told candle on a 15 minutes, then the consolidation, first entry you take, obviously your first entry is 25,080, market moves up to 140 also, again it starts reversing, it has not closed above the average. Even if you exit here, with the second average as a stop. If you use the other indicators, the exit strategies, there are different strategies, but I am taking a stop loss here. Once I enter on a reversal, I would see around 25,100. My stop would be 25,180, or even my adjustment above this candle high 25,150. So around 50-60 point stop loss adjustment is a different trick, again a different game. It is unable to cross, and the gauge of the trend is clearly witnessed. Here also I would enter the positions around 25,087. Re-entry of the position would have been done, and the continuation happens here clearly towards the multiple addition of positions. Here you would have entered exactly in this candle 25,030 the next entry, and 24,940 is the next entry. Three entry points have been defined in a beautiful way, in a simplistic way. Let us say, even if you use this entry, the gauge of the trend is imminent, and how you can capture the trend. Similarly, in this sideways band, whipsaws happen. How to identify the sideways markets is a very much key. Once there are different parameters for that, different trend identification of the markets. See here, once these kind of breakouts occur after a consolidation, you are going to buy on the different trends again. Well, I would start entering the positions from here only. Strength of the candle is very much important when you get the gauge of the trend. Sometimes it fails also, but you need to understand the momentum. With the tight calculated stops, adjustment of the stop losses, even 40-50% accuracy, these kind of trends, if you are able to capture, you are going to win in the markets. Overall, 50% accuracy is enough if you are able to apply the strategy and enjoy the trends. Here, after the range bound consolidations, markets have started inching higher after a multi-time consolidation. See, selection criteria should be there for the trades also. After a strong consolidation, if it starts trending, time consolidation, then the trend obviously would be strong in the markets. The markets would show the strength. So here the entry points and stop losses also we are defined for the buying. So couple of trade setups we have clearly identified. Now let me come back to the moving averages again. Let's come back to the presentation part of it. Some discussion. We have discussed the trends, how to ride them with the addition of position, like position building and trailing your stops. So now let us get back into the different types of moving averages. See, key is to identify the support and resistance zones, and also the power of defense is very much important. If you can use them as a support or a resistance, it's really very good. As Becky Novak has quoted, offense can win you games, but defense can win you championships. I'm going to give you a small puzzle before entering into the next part of the session, which would be much more exciting. And also, I'm going to share more of the insights to make it exciting and enthusiastic. Here is a puzzle like a 9 dots. How you connect and think out of the box is the key. See, what I have done is a simple puzzle. Here, 9 dots have been connected only by the 4 lines, like a kite. A line 1 connects from dot 1 3 7 1 4 7. Extend the line and connect it to the 8 6, and then 3 2 1 1 5 9. So this becomes a kite. So this is the thinking what one needs to have, and they have to be mature enough to think out of the box and use it. Their indicators are lagging, price action is leading, but there will be a noise in the price action. Selection criteria is very much important while you are trading the markets. So here are different types of moving averages. I'm going to name them, but I'm not going to explain the formulas. You can Google it. You are going to get the formulas. So simple moving averages are there, where I showed you how the summation happens. Weighted and exponential moving averages are the two averages where the more recent prices there are, like around, if you are calculating a 20-day moving average, the most recent 5 to 10 days averages have been given the more weightage, so that the recent data will be having a higher weightage. That will help us to get the gauge of the trend. There is a double exponential and double exponential, like indicator on indicator is there. Triple exponential moving average is there. Displaced moving averages, linear regression, and also volume weighted moving averages, which I like because volume gives us the insights of the participants and price gives us the indication. So VWMA is also good. Equal weight is given in the simple moving averages. Exponential moving averages multiplies the weight of more recent price data basically, and also smoothens the average than SMA, and it's faster, comparatively faster than simple moving average, and more relevant to the recent data. Weighted moving averages assigns different weights to each closing prices. So that's the small definitions. So you guys might be wondering like how to select the moving averages. Which of the moving averages can be used to our advantage? There are different types of moving averages like 5, 10, 20 as a short term moving averages, 30, 50 as a medium term, like a short term trend, a medium term trend, long term trend. For that gauging, we are going to use it. 30, 50 are the medium averages, 10, 100, 150, 200 are the longer term moving averages. So split it into three parts: short, medium, and long. There are different. How many of you know about the Fibonacci series? Friends, how many of you know about the Fibonacci series? Great, Satish Kumar knows it, Radhika knows it, but I'm going to blow your mind off in another session we are going to take. It takes more than a day, like couple of days. I can educate you on the Fibonacci, because Fibonacci is a very, very, very class indicator where. So Fibonacci, what do I mean to say, is a very, very, very exceptional indicator where one can use it to the precision point. It is immersed in a human body to everywhere. I'm going to take one more session on the Fibonacci sequences and indicators. So no need to bother, no need to worry. We are going to do the one more exceptional session on the Fibonacci series. Hope I am clearly audible to all of you, my dear friends. My voice is clear and audible. All of you are energetic. So let us discuss the Fibonacci in the different part of the session. I'm going to brief it for the moving averages part. I'm going to just discuss as the Fibonacci sequence starts from 1, 1, 2, 3, 5, 8, 3. Leonardo DiCaprio invented the Fibonacci in the 30 Leonardo Fibonacci de Pesa in 13th century. So a mathematician who invented the Fibonacci, but in the ancient Indian structures before 13th century, we have been witnessed that the designs of our architectures are used with a Fibonacci. We have an older history. That's the another debate. I am going to share you the multiple insights in the next or the other part of the session, where we are going to do the Fibonacci concepts. But here, how to use the Fibonacci is very much important. These are the Fibonacci numbers, but Fibonacci short-term averages like 5, 8, 13, even 22 can be used. 21 is a Fibonacci number. 21 plus or minus 1, 22 can be used. So 5, 18, 5, 8, 13, and 22 are the short-term moving averages. 34, 55, and 89 are the medium term moving averages. 144, 189, and 233 are the longer term averages. So why we are splitting it into three parts? I'm going to share short term trend, medium term trend, long term trend. If you use the combination of two of them or three to four of them also, it is viable. That is what we call it as waves. See, one more combination, what I'm going to say is 2243 or 2263 monthly number of working or trading days is 2243 is bi-monthly, 63 is a quarterly average. 50 and 200 are the golden ratio. Everybody knows if the stock is trading about the 50-day and the 200-day continuously have a buy, but that is the old traditional one. We are going to revamp it. Now we are going to use the averages in a different mode. I'm going to share you the waves. Like I'm going to share you the waves. Let's come back to the charts again, my dear friends. Okay, great Rajikadi. I am audible. I am going to share you the waves now. Let us define ourselves. Let's take a chart of Sensex here. So what I said, 10, 20, 30 moving averages. These are the waves. Even I can use it as 50 as a wave ribbons. Here, why? Because to get the gauge of the trend. See, what you need to do, it's a simple strategy. When the price breaks below the averages, you are going to sell with the powerful candles. What happens? There will be a continuation. Like once the wave starts squeezing, let us say here the waves has given us an entry. Similarly, here the waves have started squeezing, coming closer. So what you need to do, once the waves have started closing, coming closer, you need to exit. Apart from this, I'm going to give you a entry point. This is one more strategy where one can use it for the short term trading. Hold on for a minute, my dear friends. I am setting up the certain points. Let us see it on the Sensex charts or on the Bank Nifty charts even. So Bank Nifty is better. Why we are using this 144 line? So 144 line helps us until if the prices are trading above the 144 line, we are on the buy side, or else you can use it even on the 89, which are both the Fibonacci numbers, nearby Fibonacci numbers. If you want a shorter trades and terms, like until the prices are trading above the 89 average, you are on the buying side. If it is below the 89 average, you are on the selling side. So that is a definite entry point, defined entry point. Let us say we have drawn a 10, 20, 30 period moving average. Whatever the parameters, high low or high low close, you can take it. Just adjust it as per the momentum. Oh, I think some issue has occurred. I don't know what has happened. Sorry, guys. Sorry for the wait. So, what I mean to say, it's all the fractals, the swing highs and swing lows, which we use it as a indicators with the Bill Williams fractals. The averages, what we have shown you here, are like the averages which help us set up, like starts with the 13 period average and smoothened with the 8 period average. Jaw teeth starts with the 8 period average moving average with a smoothened 5 period. Slip starts with the 5 period average smoothened with the 3 period average. So the same we are applying it here. The same fractals we are applying it here with a simple setup. See here, I'm going to show you how to set up the Bill Williams fractal. If you are using the trading view, wherever in your brokering account, or else if you are using a premium trading view or a basic trading view, just let's not even set up a support or a resistance points. First, initially, let us understand. I'm going to repeat again. Sorry, my dear friends, if there was an audio issue. Sorry if there was an audio issue. If it is not audible, I am going to repeat again. No need to worry, my dear friends. I am going to repeat again. Hope it's fine with you guys. So I have also shared the waves like 10, 20, 30, the waves what we have used. Here the entry points like in a bank nifty, entry point 1, 2, 3 and 4 are the entry points, and the exit is below the averages. If we close below the 10, 20, 30 averages, it's a exit. Like we have taken a volume weighted moving average as a 89 as a trend decider zone. Volume weighted moving average as a trend decider. 89 or 144 one can use. 89 or 144 one can use. See, for to identify the trends as per your comfort and the speed of the trend, you can change the averages. This one you can use even 55 also, or 3 months 63 also you can use. It's not the problem. Here one needs to understand the fib numbers gives us the better result. So I'm using 89 or 88 as a this average which gives us the results. So 144 or 89 I will use based on the stock or the any other asset class. With the moving averages ribbon 10, 20, 30, we are using the averages, the simple waves where the wave starts expanding. If it is trading above the 89 average, the volume weighted average, the moving averages is giving us the entry points like entry point 1, 2, 3 and 4 which are defined. I would enter at least the 3 entry points when riding the trends. The fourth I would not prefer entering, as the trend is maturing, the entries are dangerous. So position sizing here at the start of the trend is important. Obviously, if we may fail and some whipsaws might happen in sideways markets, but when you can ride these kind of a trends and some criterias for sideways markets and entry you can set in, that will give you the great results. Again, the bell told candle here. Always it is very much important to identify the candle strength. Anywhere you get a strong bearish candle or a bullish candle, see here there was a very important entry point. The strong bell told candle was identified. This is a very important candle. Similarly, a strong bearish bell told candle was identified. Whenever this strong kind of a candles occur, it's a very important point, and if it doesn't retrace more than 40-50% of it, then it is a strength of the trend, ongoing trend. That is the more sure entry for traders. If the bearish candle, the strong, bigger, larger the candle is, and the strength for the next few times or few minutes if it is evident, then the strength of the candle will help us design the trades and define the momentum and gauge of the trend. See here, the similar way we are able to see the strong candle. So this is the bigger candle from 25 159 to 257. Once that is not retraced and the momentum gains with a breakout with the first entry 25 255 above, we are going to enter. Again the re-entries could have been taken in this trend, and the exit gave it here where almost the reversal came. The strength weakness of this candle, again a bear candle is formed here with the strong reversal. Strong reversals, usually we track the stronger reversals. See, this is the bear candle where the reversal has come, and see when this kind of trend comes, at least you can get the gauge of the trend with entry and exits. This is one more trend, and again the same candle concept you can apply multiple places, same candle concepts. Here also we can see the same candle concept, the strength of the candle, and here again those trends you can ride. I am only defining the entry points now. Here also similar way, the bears have given the entry first time, and the first entry as well as the second entry bears are giving the confirmation. So these kind of a momentum would give us the confirmed trades. This is one of the indicators along with the moving averages what you use. Now the voice is audible, hope so for everyone. MA Indrajit, the MA ribbon setup I'm going to share. See, this is like around the Bill Williams alligator principle. What I discussed is jaw, teeth, and lips. Jaw, teeth, and lips. 13, 8, and 5 period averages are smoothened by 8, 5, and 3. This is the ribbon what we use. And the different averages also we are discussed, like in a month 22 trading sessions are there, in 2 months 43 trading sessions, in 3 months 63 trading sessions. So that gives us a monthly, bi-monthly, and quarterly averages. The fib averages also discussed, hope you have got with the fib averages. Short term MAs like 5, 8, 13, 34, 55, 89, and also 144, 189, 233 long term averages. As we are going to split into short, medium, and long term, combination of averages can be used. Ultimately, what all the important points, how to use the averages, like tricks to use the moving averages, volume weighted moving averages for getting the gauge of the trend and the direction. See, you can use the volume weighted averages at least until if the wa- price is trading above the volume weighted moving averages, then only on the buy direction we are going to take the trades. If the price is trading below the volume weighted moving averages, like around 89 or 144 the parameter says, that's what I was sharing. Like also you can use multiple time frames to define the support and resistance points as the trading clusters. Golden ratio we call it for the stocks, like around 20, 20 50, like 50 and 200. If the price is trading above the 50 and 200 day averages, one can trade on the buy or sell. Like I am, whatever the discussion we have done, that is what the points I'm sharing here. A combination of short, medium, and long term averages are there. As we have discussed, waves also we have discussed, like 10, 20, 30 is the setup. Alligator strategy is 13, 8, and 5, offset by 8, 5, and 3. Indicator on indicator, nested moving averages. See, usually some trade the mean reversion strategies. If the price falls too much in a larger degree, let us see the same on the stocks also. The averages in the stocks, how it helps in trading the stocks in intraday. Let us see it on the stocks. The application on the stocks, like see the bullish bell told candles wherever it has occurred in the last week. We are going to take the top gainers of the previous trading session, 5 days trading session, the bull candles, multiple places the bull candles and the price breakout is helping us to enter with the defined stop losses. Nothing exceptional we are doing. We are just seeing the top gainers, how the momentum is rising with the averages. See how one can ride the trends. See, these kind of a long bars, usually completely big long range bars, we are going to avoid. Similarly, the consolidated bars we are trying to enter. We call it in the price action terms rally base rally, which is happening with the averages. The momentum and the gauge of the trend will help us to ride the trends. A small long range bar after the consolidation here, a strong consolidation has happened. See, can we guys see this consolidation? Once the consolidation gets over, here is the entry point on 5450. The band of consolidation and the squeeze of the MAs happens, and the expansion starts. See, from here, the entry point we have taken, then the expansion starts in a delayed phase. Here, the squeeze on the sideways happens. Even if you exit here, it's like around 4 points. The re-entry could have been done again above this. Obviously, the re-entry could have been done. Still, no exit. Exit has been signaled here, but we can wait and watch. Once below this, if it trades, I'm going to exit the trade. So, based on the price, the long range bar is created. The long range bars are very much important in trading the moving averages along with the price clusters. So, this is the alligator strategy, simple way how we are trading the stocks. I am using this ribbon. See, different stocks have got different beta, so one needs to understand the beta. Until you don't understand it, you can't trade those stocks. So, understanding the behavior of the stocks is very much important. Some parameters work well when there is a V shape reversals like this. Moving averages are dangerous to enter in these V shape markets. So, your exits you can define with the different parameters, price action, and the candles as well. uh, this is a V shape sell, V shape buy during the event result. This was a smoothened entry. See, alligator strategy, I'm using the long range candle for the Bank of Baroda for trading or any stock. Rather you define after a rally consolidation happens and the averages start the reversal here. The entry point has been triggered at this point 2432 with 2410 as my stop. The riding of the trend and the wave starts squeezing here. I'm going to 2481 would be my exit point at the end of the day. So even at a intraday, simple strategies can be applied, my dear friends. So it's not that if what happens here, how to filter the trade, it is not even trading below this 89 period average. So what I'll do, I'll not sell here. If the reversal occurs, this sell would have been avoided. I would have sold here only if price breaks. If I would have sold here, the exit would have been here only. like around 3 4 points loss again. The breakout in the price has not occurred here. The consolidation is happening. Price has closed the, it has not closed above that. Once the breakout here it has occurred, it has not closed, or the momentum has not been gaining above this high 1785 above. So here the selling point has been triggered. Selling point has been triggered here 1776 in Oberoi reality. But below this low I am going to sell. My stop would be above 1785. So we need to watch out those scenarios. So even on the sell side, buy side, we have seen lot of it. How the long range bars are giving us the entry. The price is trading below the averages and the volume weighted average. So the momentum is clearly down. Now this long range bar on a reversal, I'm going to enter as a aggressive trader. But as a breakout trader, one has to enter below 1825. Then the momentum has been consolidating. The waves here, sideways action after the fall has happened. So oh, what has happened here? Understanding the trend is very much important here. See what is happening here: fall, base, fall, fall, base, and fall. Rally base rally we are seen with the price action here. The indicators like that, along with the alligator principle, I am using a 3-minute chart to trade. What I would do, I would enter below the volume weighted moving average, the exponential what we have taken with the averages and the bell told candle. I am going to enter the trade. Along with that, we are riding the trend until it is below the trend. I am going to trade it on the sell side, even on the different degrees. So my trend has to be bearish. If I am selling here, sell base sell. So my first entry is safer, and here I'm going to sell it below it only, below the averages. Simple way. The stop would be above it. Continuation happens. Then again consolidation and the continuation, fall base fall. So this is how I am going to use the stocks as well. So how to use them as a, let's take some beta stock rather than, okay. See different periods from 2 minutes, 3 minutes. Similarly, if a price is acting as a support for the moving average, one can define the same moving average as a resistance zone. See, multiple times the price has broken below here, the consolidation has happened here, the double top kind of a pattern has occurred. It is acting as a resistance, the moving average. Then again, the fall is starting. So, one can use the different time frames to identify the support and resistance using the moving averages. Obviously it will help us to identify the reversal points. Here again, see, it is a short term average has been tested after the fall, and it is defined to act. A fall retest of a 13 period average on a 45 minutes, again a retest, then it is clearly acting as a resistance zone. So basically, the averages in different time frames can be used as a support or a resistance points, like how multiple supports have been tested in the BPCL. Once the trend has started higher, it is acted as a support. The 13 period average on a multiple times. Once it has started trending here, it is respected the 13 period average. You take it on the Nifty also, or any stocks, depending on that you have to change based on the stocks. Obviously you have to change the averages on the different time frames. See, Nifty has clearly respected once the strong bell toed candle is formed, and the 13 period average has been respected until the sideways action has started in the markets. So that gives you the gauge of the trend. One can identify the key support and the resistance points with the combination of parameters using the moving averages. It's not, nothing is a holy grail in markets, but use of it to your advantage to identify the support and resistance, understanding the gauge of the trend. Do you guys understand what I mean to say? Mean reversion strategies are also there on the moving averages, like indicator on indicator is moving average on a moving average. If we have a 10, 20, 30 moving average, so based on that, now I'm going to define a indicator on an indicator. Let us say these are the averages which are there. I'm inserting a exponential, double exponential moving average. See here what it is, double exponential moving average is defined along with the volume weighted average. The source is from the volume weighted average. I take an indicator on an indicator. It helps us to get the gauge of the trend. I'm avoiding this ribbon now. I'm simply it. It's like indicator on indicators. So couple of averages we are used, even as a bands we can use as the high and low. Let me design here with the different averages. This is let us take it as now let us take the 13-day average on the high. I'll add one more, this one, exponential moving average. Similarly, on a low, 13-day average, let us make it 34 on the low and 34 on the high. See, here are the two averages based on the high and the lows. One is 34 on a high, 34 on a low. We are using, if there is a price is trading above the higher band, then one can buy. If the price is trading below the lower band, one can sell. So this is a high low concept what one can apply also. If the prices are trading below the band along with the combination, and above the band, one can take the entries. High low trades also can be done with the moving averages. So this is one of the more beautiful examples. The sideways markets also can be identified if it is trading within the band. Different bands can be used as well. So these are few of the parameters. Like mean reversion means if the price falls like around let us say here in the moving averages, I'm using only the closing prices to get the gauge of the trend now. There is a deeper fall in any of the stocks or a steep rise. So this is one of the deeper falls, 8%. We need to see the important price cluster. Uh, if the fall is too fast and too deep, the mean reversion like around 20%, 25%, that is what we call it as a mean reversion strategy. If the prices are fast enough to fall, and one can take the mean reversion strategy near the bottoms, one can take the mean reversion strategy. So around 20 to 25% reaction on a 25-day average. Just if the price reverses 20% from the 25-day average, exponential moving average, 25 period average, so there one can take with the different clusters to enter. So, guys, hope all of you enjoyed regarding the moving averages. Do you like to extend the session? I'm going to compensate with the risk and the money management strategies. How one needs to use the risk as well as money management strategies. If you would like to learn, say yes. Say yes in the chat box if you would like to learn the risk and money management. Any questions for 2 3 minutes, 5 minutes? I'm going to take on the moving averages. Then I'm going to explain you the risk as well as money management parameters in a very simplified way. It's all about what we have learned on the moving averages. See, mean reversion. Mr. Sriram is asking how will we do the mean reversion? Mean reversion is simple. If we are having a 25-day moving average or 25 period moving averages, price falls faster in that retracement in a strong note, there you are going to use it. The reversal near the support, if the price is near the support and a strong mean reversion has occurred, like a v-shaped fall or v-shaped rise has come, there on a contrarian bet one usually sells for the reversion. Mean reversion means price has abnormally gone up or abnormally come down, knee jerk reaction, from there the reversal trade occurs, that is called as a mean reversion. Many a traders use that, but that is with the clear stop losses. If you trade, then only the mean reversion strategies has to be applied. It's completely a contrarian, it's not a trend following method. Oh, any more questions on the moving averages, my dear friends? Any more questions on the moving averages? If you have any doubts, the strategies what we have discussed, a band is made with a high and low, sir. Basically, 10-20 can be made, or even 13-13 can be made. Let's make one band here to simplify it. Let's use this only. High of 13, low of 13. I'm not exaggerating anything. Only one average is getting formed. Let me sort it out. These both are double exponentials. See, this gives the smoother flow of the trends. A high and low bands are formed here. On a time frame. Well, we will use any of the parameters to trade, basically to trade and establish the gauge of the trend, a volume weighted average to get the gauge of the trend. Obviously we are going to use it at least 55 is viable to get the gauge of the trend. If you are using the averages, the bands can be made with the different Bollinger bands, linear regressions. I am showing it on a averages, so that is how bands are made. Yes, which EMS are better for scalping, ribbon or alligator? See, ribbon, what it is, waves 10, 20, 30, what I given you, that will help you to the waves for day trading. And alligator is the best one because it smoothens and offsets. But the use of the candle, what I shared, Satish Kumar, you are going to get the recording as well. The combination of parameters, note this is just one part of it. Obviously there are five parts which are required to establish the trades, five different clusters which we are going to learn one by one going ahead. See, this is alligator. Once the consolidation, the long range bar in the mankind pharma, the alligator principle is obviously proven strategy by the Bill Williams, but you need to have a model to avoid the sideways markets, or some entry criteria and other parameters has to be defined while using the moving averages. Simple strategies do work, my dear friends. Now shall we discuss? Are you guys ready for the risk as well as money management? So basically, there is a video in the YouTube channel also, a risk and the money management video. Are you guys ready? I am going to brief in some 10 minutes. Can you extend if it would help you? If you guys are willing to learn more, say yes in the chat box. If you are going to, if you like to learn more, say yes in the chat box. Okay, definitely I'm going to share the RMT model now. Oh, great. Many of them are interested. You are showing the interest in the Sunday, the holiday time. So, obviously, I would be more enthusiastic to share the risk money and the trade management model. Risk money and the trade management model. Hope my screen is visible to all of you. See, obviously, there are three parameters in trading: one is risk management, one is money management, one is trade management. If you can act using these things, you then only you are going to succeed. Potential reward, like if you buy a stock at 100 rupees, let us say, if you buy a stock at 100 rupees and you have a stop loss of 90, you have a stop loss of 90 and your target is 120, the risk is 10 points. First part of the sutra is risk management, which we are going to discuss now. Again, risk is 10 points, reward is 20 points. Repeatedly you take 10 trades. Let us say you repeat the same trade for 10 times. As I would say, 50% is your accuracy. Here is the mind-blowing fact, my dear friends. Accuracy doesn't matter in the markets. I'm going to share now. Like trade one, you win, you make a profit of 20 points. Trade two, you are going to win profit of 20 points. Out of 10 trades, 5 trades you are going to win. 20 points into 5, 100 points is profit. 5 trades you are going to lose. Like your stop losses are going to hit from 100 to 90. Same action you repeat 5 times. 50 points is your loss. Still you are in a profit of 100 minus 50. That is 50 here. See, this is what we are seeing. 100 minus 50 is 50. Still, If you have, that is the risk reward ratio of 1 is to 2 with a 50% accuracy. If you have a risk reward ratio of 1 is to 3, win ratio of 40%, like 100 rupees you buy a stock name X and you have a target of 130, so your reward is potential 30 into 4 is 120 is the profit. 6 trades you lose, 6 into 10 is 60, so your net like a gross profit is 60. Still you are in profit, my dear friends. Even at a 40% win rate in trading, you don't need to win even at a like 1 is to 2 risk reward ratio also, still you will be in profit 40% of the time if you win. It's not the accuracy that matters. What do you say? The risk management, the first sutra of Ashoka Stamba, first lion, risk management is the key to trading. It is not accuracy. Take this one out of your mind. So first point, remember it. Always have a proper risk reward ratio in your trading. The second point, I'm now going to go ahead quickly, the money management rule. Let us say I give you 100 rupees as a capital, or 1 lakh rupees as a capital, and what would be your capital if you lose 50 consecutive trades? Assuming you have a 2% stop loss, like 2000 rupees per trade, your capital will become zero. Zero. Do you guys agree? Your capital will become zero. Do you guys agree? Say yes in the chat box if you guys agree. If I give you 1 lakh rupees, if you lose 2% stop loss, no, there is a catch here. 2% stop loss rule I am applying. 50 trades you are going to lose. Even if you don't know any analysis, I'm going to share you a mind blowing trick here. 1 lakh rupees capital, 50 trades continuously you make losses with a 2% stop loss, your capital will be zero. No, your capital will be 35,000. 35% of your capital you will be left with, my dear friends. You will be left with 35% of your capital. That is the power of money management. How? See, trade one you lose 100 rupees, or 1 lakh you have a capital 98,000, that's 2% of it. And on a 98,000 you are taking a 2% risk. So that is where the money management and the position sizing comes. While trading options, why many of them lose is they don't have the proper money management as well as the risk management model. That is the reason why traders lose. Either they are trading stocks, options, cash, index options, futures, that is not a matter, but the proper risk and money management is the key to trading success. So that is an iteration process. If you continuously lose 50 consecutive trades, you are the most unluckiest person in this earth. If you, even if you toss a coin out of 50 trades, 25 25, like 50-50 chance you have for head or a tail to take the trade. You have a proper risk management, you have a proper money management. You need to continuously lose 50 trades, that is next to impossible. Even if you don't know the analysis, if you toss a coin and trade, you have a proper money management, you have a proper risk management in place. That is what is the key. 1 in a million, 1 in a crore, 1 crore will lose consecutively 50 trades. That's why they are unluckiest person in the world. Don't trade. Trading is not a business for you. If you don't lose 50 consecutive trades and you trade it in a proper systematic way with a 2% stop loss rule, let us say even if I apply the 3% stop loss rule or 4%, but I have to manage the risk. Risk management and money management is the key to trading success. And I'm going to share one more model here, maximum pain model. Before that, the trade management, RMT model I call it, the trade management I'm going to discuss. That is the third lion of the Ashoka Stamba. How you do the trade management, we call it as a trading life cycle. I call it as three E's: entry, exit, error. This is the first motto whenever I educate or whenever I get the people to advise this model. I am going to educate RMT model: risk, money, and trade management. If you apply it properly, then you take an advice from me or anyone else, you will be a successful trader. Being a SEBI or a SEBI registered research analyst, my aim is to educate the traders in a proper and designated way. So this is the trading life cycle: entry, exit, and error. Entry point is whenever you enter into a position, see, know what you are doing, why you are doing, for what you are doing, why you are doing, and what will be the consequences of it. If you are taking the entry and keeping your stop loss in a defined way, and if you take the position size as per your capital and comfort, you set a objective price target. That is what a complete trading life cycle and the temperament what makes a difference between a successful trader and an unsuccessful trader. That is what we call it as a lip and a sip. So trading temperament is important. Once you enter, you have a proper defined stop loss, you have a target, and once the reversal occurs, objectively one needs to take the trade. See, this is the three RMTs, three stambhas of Ashoka, the lions, what we see in the Ashoka Stamba: risk management, money management, and trade management. That is, we call it as trading life cycle. I have defined it in a simplistic manner. Next one is the maximum pain model. Max pain model, the risk what you take, like max pain model. Capital, let us say if you have a 5 lakhs, 1 month there are 22 trading sessions, let us round it off to 20 per day, risk of 5,000. It's basically, I call it as, okay, let us say if I have a capital of 1 lakh, to simplify, per day my risk is 5,000. I take, that is 5% of my capital. In 20 trading sessions, I win 40% of the time, I lose 60% of the time. Out of 20 days, 8 days I make profits, 12 days I lose. 8 into 5,000, I win, that is 40,000. 12 days loss is 1 is to 1 risk reward ratio, that is 60,000. So net loss in my month is 20k. So always understand how much you are comfortable losing in a month. Even on a worst months, trading same pattern, same everything doesn't work on every month. If you have a proper designated risk reward ratio, money management, then you are going to win on an average. It is not that every day is profitable. Even markets are good, you might not execute in a proper way. So set your goals, split your goals in trading every week. This is my target based on my capital. Be very realistic. Understand the maximum pain model. If you lose 20,000, which like let us say you have 1 lakh capital, you have 1 lakh income every month, 20,000 I can risk this month. So if you lose 20,000 or more, stop that month. Next month you replace that risk money and take the trade. So that is how the systematic model should work. the there has to be a proper system with the RMT model, the maximum pain model. How much you are comfortable to lose. Don't risk or stake the borrowed money in trading. Hope the four stambhas of Ashoka pillar all of you enjoyed.